what, 5 minutes into market opening, 6 minutes into market opening. Ashwini Agarwal is with us, founder and partner at Demeter Advisors. Ashwini has been a little cautious the last few appearances on programs. Ashwini, great to have you back. Thanks very much for your time. How are things looking, Ashwini? Still a little cautious as we wrap this up and head into the next year?
It's a very interesting question because, I was just thinking through what to expect from 2023. And I think it's going to be a story of normalization. So by that, what I mean is that there are three events that have defined 2022. One is the invasion of Ukraine. Second is China extreme lockdowns. And the third is the tightening cycle globally. And I think that 2023 will be a normalization on all three fronts. At least I'm hoping that the war in Eastern Europe will come to an end through mediation and through compromise. That's my hope. And China and the rate policy, I think, will start to normalize. At least the pace of future hikes will stop. So with this backdrop, if you zoom out and think about it, you have to accept that real interest rates in the positive territory do provide retail investors in India a real option to invest in fixed income, as opposed to only equities. That has been the prevailing trend for nearly 5-7 years in India and nearly a decade in the West. And I think that is a very, very powerful, I would say, development that we have to keep an eye on. And that, I think, has a gravitational impact on valuation. So I think I do remain hopeful that normalization will provide some tailwinds, but I do expect that debt being a real investment opportunity will also provide some bit of a headwind for valuation expansion. I think that's how I would put it.
Okay. Ashwini, good morning and thanks for joining in. Wonderful. Greetings of the season to you. Everyone's asking the same questions, right? I mean, what's going to be the banking sector of 2023? I mean, banks were the big buys in 2022 and IT was the big sell. You think it's going to be more of the same, or are we going to have new leaders?
I remain positive on the banks because, despite the sell-off that we've seen over the last week or so, I think, it is a sectoral turn in fortunes, which is a multi-year cycle. And I don't think we should be too early to give up on that cycle just yet. Credit growth is looking good, spreads are looking healthy, and credit costs are way below trend. And I don't think the estimates capture everything right now. So I think I would continue to stay positive on the banks. I also think that IT, which has been a terrible trade for 2022, will turn around sometime in 23. That's something that's looking positive. When I started to look at it, I haven't kind of pressed the button yet, but I think valuations and earnings are starting to normalize quite rapidly. Earnings expectations are starting to normalize quite rapidly. So I think sometime in 2023, that will be a trade to watch out for. And I think pharma, which has been quite a dog, honestly, for the last 3 years almost, should see a turnaround as raw material costs normalize, as transportation costs normalize, and as demand patterns normalize in a post-COVID world. I mean, COVID saw an initial surge in demand for medicines, specific medicines, and then there was overstocking, and raw material inflation and so on and so forth. So I'm hoping that normalization, as I spoke about earlier, will be a positive tailwind for pharma stocks. So those, I would say, that's how I think 2023 will play out. But 23 will also be a significant bottom-up investing opportunity. See, I joined the markets in 1992. Between 1994 and 2003, the index more or less went nowhere. But there were a lot of bottom-up investing opportunities, and I think that is the market that we are going to see for 23 and possibly even for 24.
Well, that's usually the case where, there are a lot more opportunities in the bottom-up space, etc. as well. But, you said that debt could be a real investment option in 2023. If one was to allocate some part of their portfolio to debt, how much would that be, rule of thumb? And secondly, if interest rates are likely to rise, debt is likely to give you a lot more returns or better returns than equities. then do you think some of these rate sensitives will get affected in terms of returns? I mean, are you looking at real estate space? Are you looking at autos? Are you looking at housing finance companies?
So let's take this one by one. First is debt equity allocation. That totally depends upon every individual's risk appetite and I would say age. Age in the sense that the closer you are to your 50s or 60s, the higher should be the debt proportion. And the younger you are, you should have more equities. I mean, if you are in your 20s or in your 30s, you should probably be 100% equities. I mean, you've got 20 years of earning life ahead of you. Why would you not bet on equities with all your savings? But I think as you get closer to your early 50s, mid 50s, it should be maybe 30% debt, maybe 40% debt, somewhere in that ballpark. That's my personal opinion. Obviously, you have to tweak it for every individual's risk appetite. As rates go up, there will be opportunity to invest in more debt. I would start going up duration right now, probably a little bit, and then maybe 1 or 2 rate hikes are left, but they are well expected. So I don't know whether you're going to see a significant move in the long end of the curve. So probably makes sense to go up duration curve right now. And coming to the rate sensitives, you know what? Autos and real estate are not classic interest rate sensitives in the Indian context because they're determined by demand, they're determined by affordability. Real estate has been on a down cycle for nearly a decade. The upcycle has just begun. My belief is that real estate cycles are very long, multi-year cycles. So I don't think that we should pull the plug on it just yet. I've said several times before that I've had difficulty finding real estate stocks to invest into because each stock comes with its own challenges. But anything that's a play on real estate looks interesting to me, and I wouldn't call a top on that yet. Housing finance companies is a different kettle of fish because here the banks are competing very aggressively, and housing finance companies don't really have the cost of funds advantage that the banks have. So unless it's a very unique situation, housing finance companies in a rising rate environment find it challenging to manage their cost of funds. There is, of course, courses for different courses for different horses. So there are some housing finance companies that benefit in a rising rate environment. So that could be an exception.
Courses for horses or horses for courses?
Horses for courses. Sorry.
No, I'm just pulling your leg. Ashwini, this on real estate, right?
Yeah.
So the accepted wisdom is exactly what you said, that cycles are usually long and they last for many years. But the point is that most cycles, economic cycles are much shorter. Market cycles are becoming shorter and shorter and shorter, right? We all talk about this rotation very quickly from one. So why shouldn't real estate be a victim of that same shortening of the cycle in that sense? Actually, we had a real estate expert from Knight Frank at one of these conferences saying that according to him, the cycle will be about 3 or 4 years long. And we're already in year 2. Your thoughts, Ashwini?
It could be. It could be that instead of a decadal cycle, it could be a 4 or 5 year cycle. But I think the answer is demographics as to why, this cycle should not be as short as, other market cycles is demographics. I mean, look at the number of young people entering the workforce, the nuclearization of families, affordability of real estate. I mean, Bombay is a bad example because it's really expensive compared to the median income of, let's say, a 30-year-old or a 35-year-old. But most other cities and towns, I would say, real estate is very, very affordable. Looking at long-term past trends in India, and credit availability is much better today than it was 20 years ago. So I would say that demographics is the difference as to why real estate cycles shouldn't be as short as other market cycles. But yeah, it could be a 4 or 5 cycle, who knows, instead of a decadal cycle. We'll have to see how things pan out.
Okay. You know, it's interesting. I mean, you were telling my colleague Mangalam about how when you're in your 20s and your 30s, the best place to be is equities, right? And we generally talk about the here and the now, but if you take a longer sort of a 10, 20-year timeline, you notice that there are outsized gains that you can make, even in individual stocks. I mean, for example, today, of course, it's 28 December, so we're talking a lot about Dhirubhai Ambani's birthday and how Reliance has generated outsized wealth for investors over the past. I mean, it's an annualized return of 20% that Reliance has seen across all its key financial parameters in the last 20 years, and that's quite a bit. So tell us a little bit about whether one should stick to large caps. Is that the place to be now? Or for this year and the next, perhaps you see outsized returns in mid caps. How does one really position themselves portfolio-wise?
You know, Sonia, if you look at the behavior of the small caps this year, obviously it's volatile, but small caps are down significantly, whereas the market is flattish, give or take, right? When I look at bottom-up opportunities, I find a lot of interesting ideas at reasonable valuations in the small cap space. So my personal view is that at least, for a long-term investor, it should be a mix across the market cap curve. So if you're picking mutual funds, it should be a mix of index funds to play the large caps. It doesn't make sense to buy large cap mutual funds. You might as well buy the index. And then you should have a reasonable exposure to mid cap and small cap funds as well. Small cap funds have a lot of volatility. So that's the problem with it. So if you're watching your NAV on a monthly basis or looking at your portfolio every fortnightly, it's likely to give you some heartaches. But if you look at the long term, and you say, okay, I'm in it for the long haul and I'm going to stay invested for the next 10 years, 15 years. My bet would be that small caps would give you marginally better returns than large caps. The way to look at this is, a bottom to bottom measurement, a market bottom to market bottom measurement, where you look at a small cap index versus a large cap index, or a market top to market top. So across a cycle, when you look at across the cycle, small caps give you a couple of percentage points more than large caps at the index level. And usually funds do much better because here there is a significant information arbitrage. There are a lot of inefficiencies in small caps. So I would say that long-term small caps should give you a better return than large caps.
All right, speaking about big returns, Page Industries has moved to the high point of trade. This morning there was a note coming in from MK, which put the target price of the stock to 50,500. I mean, the IPO price for Page Industries was just about 360 odd rupees. So this is another example of long-term wealth creation. Page Industries up at the high point of trade. Ashwini, we haven't spoken about the consumer space in India. You alluded to the demographics, etc. I mean, there is a large swathe of Indians waiting to consume the best of products. I mean, and I'm not talking about the entry-level products where there is some sort of stress, but consumer discretionary, premium, etc. Do you see any opportunities there?
Yeah, I do see some opportunities, but consumer stocks over the last decade have been significantly re-rated, and many of the stocks are very, very expensive. They're expensive, on valuations on a +1 standard deviation basis even today when you look at a 30-year, 40-year history for several of the stocks. So the valuations don't give me comfort. I love the businesses. I love the long-term opportunity. But I don't like the price point. So barring some few exceptions on a bottom-up basis where you might find a bargain, broadly consumer discretionary as well as the consumer staples space remains quite expensive is what my view is.
All right, we will leave it at that. Thanks a lot for joining in, Ashwini. Have a great year ahead.
You too.
Hope the year is filled, more importantly, with peace, health, love. Money always comes last, right? So hope you get everything that you desire this year. And thanks a lot for being a friend and follower of CNBC TV 18. Well, that's Demeter Advisors talking about the year to come. But one space that has done exceptionally well this year is banks. So we talk about that. Canara Bank is the stock on our radar.